bit of background about myself. So I've been in and around the startup scene for the last 10 or 12 years or so. That included running my own startup, going through accelerator programs, running accelerator programs, and then helping a bunch of companies either spin out or get funded as well. So, you know, as I say, I've been around this space quite a while. I understand the, I suppose, the pitfalls of equity, and I hear these stories all the time. So I work with a company that many of you will already know, which is Global Shares. We're a Cork-based company, so we are actually headquartered in Clonakilty, but we actually have an office in Cork as well. So between Cork and Clonakilty, I think we have somewhere in the region of 300 employees in around Cork, which is really a great story. And for me, I'm personally very happy to do a little talk for Republic of Work. Going back to, I think, the very beginning, I think I ran the first event in Republic of Work about 5 years ago. I think it was actually just before the official opening. So again, delighted to be here. So what I'll do is I'm going to just share my screen, run through a couple of slides, and hopefully you guys will pick up something useful from the discussion. So I suppose as a starting point, you know, this is one of those stats that's really impossible to prove, but I speak every week to law firms, financial advisors, various people who are advising startups at their funding rounds. And I've played around with this number a little bit. I've asked them, you know, what do you think? Is it 60%? Is it 70%? Is it 80%? And 90% is the one number that they all say. 90% of the law firms and advisors I speak to will tell me that almost all, like 90% of the private companies they deal with will have a problem at their funding round. And it's a problem with their equity or their cap table. And it's not the first funding round, it's all the funding rounds. So even when problems get fixed at a particular funding round, if the company doesn't look after it, guess what? Those problems come up again, or a variation of those problems come up again at the next funding round or exit. So this is something that's really important. And I just want to hit one thing on equity, right? Equity to a lot of people is not going to be the most exciting topic in the room, but I just want to call out one thing. We've all heard about startups that get acquired because they've got this amazing product, right? This innovative product, or the startup that gets acquired because they have this fantastic tech team, or the startup that gets acquired because, you know, they've got this great customer base. They've built up this huge customer base that somebody's going to cross-sell into. Now, while all that may be true, the company that's acquiring does not acquire the people or the product or the customer base. Legally, they acquire the equity, right? So they acquire the equity in that startup. So it's really important if you want to go through those funding rounds, if you want to get an exit, whether it's an acquisition by another company or an IPO down the line, it's really important that you understand your equity, you understand what makes up your company, because if you don't, it's going to come back and bite you time and time again. And to the point where, you know, every law firm that I speak with talks of deals that have fallen through because companies didn't understand their own ownership structure. So just to hit on this just for a moment. So Global Shares, who we are, as I said, we're a Cork-based company. We've over 500 employees now. And we work with companies who have employees in over 100 countries around the world. And what we have always done for them is help them with their employee options, their employee share plans. I joined the business a couple of years ago to build out our focus on startups and scale-ups, which is something that we've been very excited to do. And why, I guess, you know, for Global Shares, we as a company, we understand these challenges firsthand, right? We understand growth, hyper growth, scaling up. These are all things that we have been through and are still going through. I'd like to say, you know, 2018. So in here where you see that inflection point, I'd like to say that that's just because that's when I joined, but it's not really. It's at that point we took on $25 million investment to scale and accelerate that scale. And you can imagine the preparation that goes into something like that and the problems that you have to deal with to actually grow from less than 200 employees up to 500, nearly 600 employees in a very, very short period of time. One of the things that we are really proud of is the fact that we ourselves are 30% employee owned. So when we look at that growth, we look at the value of this company increasing more and more, we know that a huge amount of that value is going to our own employee base. And even as I mentioned, about 300 of those employees are based here in Cork and Clonakilty. So we know that there's a huge amount of wealth that's being created within this company, which is actually going to pour back into the local economy here, which we're very, very proud of. So I guess there's just, we talk about equity and the foundation stone of your business, and particularly your cap table. And I think you guys may have had a talk on this related to this recently as well, but it's just worth re-emphasizing the point here that your equity is your business, and tracking your equity, that's the purpose of your cap table. So it just keeps track of who owns the company, what they own in the company, so what types of shares they own in the company, or maybe they own convertible instruments or pre-money or post-money safes, and having all that record keeping squared away, nice and easy to understand, easy to communicate, is going to help you massively in future funding rounds and obviously a potential future exit. I want to call out just two things here at this point, and then we'll maybe just talk about a few pitfalls, but just two things to consider. The thing that we see most often is early stage companies managing their ownership on spreadsheets. And that's okay. That's absolutely okay when you're an early stage company. When you've got 2 or 3 founders and maybe 1 or 2 employees with a little bit of equity, maybe a couple of angel investors, it can be really relatively straightforward to manage your cap table on a spreadsheet. The one thing I would say is just manage your version control of this, because you don't want to be at a funding round and have an angel investor say that they've got a different version of the cap table than you have, because this is where you start getting blood on the walls. So the one challenge that you will have with spreadsheets, the biggest challenge, the 2 biggest challenges you'll have is, the first one is just that single source of truth, so that everybody understands version control, that there is one version of the company cap table, and that you manage that incredibly carefully. But the second piece is the spreadsheets are okay in those early stages, but when scale comes in, it's going to break. And again, if you think of all these startups that go through a 5 million, 10 million, 20 million, 30 million funding round, and they're valued at 100 million or 200 million, to think about that 200 million euros or $200 million and the tracking of that and who owns it, all sitting in an Excel spreadsheet. We have all had problems with spreadsheets that, after a year or 2 with various people working on them, they just break, or there's errors in links, or somebody else says they have a different version of it. So I think while it's important to say that it's okay to manage this on a spreadsheet in those early days, as soon as you start thinking about more scale, about more complexity, about employee options, if you're going to offer something out to your employees, this is when you really need to think about something else. So what I'm just going to run through, and this is I'm not going to give you death by PowerPoint, but really just to talk through this slide, is some of the common pitfalls that we see and things that impact most of the companies that we deal with. So bear in mind, we take in company cap tables every day of the week. We go through those company cap tables, we help set them up, and we start seeing the problems that the companies would have at a future funding round if they were coming into us. So the types of things that we see, we'll run through them here. But the first one, and this is the point is the same no matter what scale or what round you're at, but it's a little bit different at each stage. So the first one is the importance of vesting. So if I tackle founders vesting, first of all, if you look at the founding teams of startups that survive the first 12, 18 months, in a very, very high percentage, probably more than 50% of startups, by the time they reach 18 months, there has been a change in the management team or in the founding team. So if we take a very simple scenario where you've got 3 founders working on something together, and maybe, after 10, 12 months, one of those founders walks out the door. If you have just issued equity to the 3 founders, and let's even say equally to the 3 founders, that person has walked out the door legally owning a third of the company. Now skip forward 6 months and the other 2 founders have worked through problems. They've got the company getting a bit of traction, and they're going raising, they're going raising their first $1 million in a seed round. And that investor is going to come in, they're going to look at this and they're going to say, look, we're looking at investing $1 million into this company. We're looking for 20% equity in the company. And as they do this, they're going to start looking for your cap table. And what they'll see is, you're valuing their 20% stake at $1 million. So then you're going to have to tell them that, by the way, there's somebody sitting at home on the couch who owns 33% of this company. And they're going to look at that and go, well, why am I paying you a million euro for 20% when this person's sitting at home on the couch, adding nothing to the future of this business, and they've got 33% equity? So what's going to result in? It's going to result in one of two scenarios. Number one, either your investors are just going to get very nervous and walk away, and they don't want anything to do with this. Or number two, you're going to have to deal with the original founder who's sitting at home with that equity. And when you go to them and explain that you want them to give back the equity, you're going to have these discussions around, well, why should I give it back? What's it worth to you? And if they get a sniff of potential investment coming in, you can be damn sure the value that they'll put on it will not match the value of what they have contributed to your business. So it's really important in those early stages that even founders, even good friends, you've all heard the horror stories, but it's just a very simple thing. Put vesting in place, and there's various theories out there on what this should be, whether it's 4-year vesting with a 1-year cliff. What's that mean? It means if you leave in the first 12 months, you get nothing, and then at the 12-month mark, you get 25%, and then monthly after that, you'll see vesting, you'll see monthly percentages go across. Now, that's very common for employees to have that 4-year vesting with 1-year cliff. It's common enough with founders as well, but there are some people who think founders should just have a 3-year cliff. So in other words, if they leave in the first 3 years, they get nothing. So you've got different philosophies, different things, but it's just worth looking into it if you're at those very early stages and being clear about it. And then as you move on, the vesting becomes really important as you start thinking about employees coming in. So again, those first couple of employees that come in, that head of engineering that you want to hire, that head of sales or marketing that you really need, and your head of customer success, one of the most important people that you might have. As you bring those people in, you're going to want to offer them equity, and particularly the days that we're in now, where talent is so difficult to get, and the job market is so tight. We're seeing now employee options are just becoming table stakes, right? If you're not going to pay what Amazon or Facebook are going to pay, then you're going to have something to offer. So employee options is a great one to do. You're selling the story, you're selling that to your employees. But again, you need them to understand that they might be getting something that could be worth $2 million, $3 million, $4 million or euros to them over the next couple of years, but there's vesting applied to that. So if they don't stay the course and if they leave, there's only certain amounts of that will vest along the way. So it's really important as well that you have a think about this from a cultural point of view. Are you a company that's going to allow those early employees to leave and hold on to their options, even after they leave, or are you going to be a company that says, look, if you leave before an exit event, then you get nothing. So these are all things that you need to consider as part of your culture and the ethos you want to build with your employees. So that's probably a bit of a mouthful, but there's vesting, and we'll cover that, and maybe if there's any questions, we can take those in the end. The second one is really simple. So again, let's go with that simple scenario. You've got a new head of customer success, and she's coming in, and you've said to her, look, this role is really important, and as part of you taking on this role, we're going to give you a 3% stake in the company, which is a huge amount, a huge stake to give. So what you want to avoid is that you're really busy. Everybody knows in the early days of startup is just you're firefighting. There's 100 jobs to be done in very limited time. You've reached an agreement. You've said it's 3%. Great. What you cannot do then is just get too busy to document that agreement, because the risk that you run is, a couple of months later, you close out a seed round, and then 12 months after that, you do your Series A, and your head of customer success feels like she still owns 3% of the company. She's not aware that she's been diluted twice in the meantime, and actually she owns 1.5 or 2% of the company. So when you talk about giving away percentages, it's really important that, first of all, people understand that those percentages equate to a certain number of shares at this point in time. So that 3% might be, 30,000 shares out of a million or whatever it is at this point in time. But as you go through future funding rounds, more shares will be issued to new investors. And as a result, you will be diluted. And it's so important that you get that documented and locked down, because again, it will come back and really, really cause you trouble down the road. Probably more now an issue as we move up a little bit past, those seed stage companies, and you look at Series A and above. If you don't have an employee option plan by the time you reach Series A, or even a larger seed round, your first institutional investor, you can be damn sure that they're going to request that you put one in place. This is something that's been operating obviously in the US for a lot longer, but we're seeing it all across Europe. And it's snowballing. It's just getting more and more aggressive. So the gap between options and incentives that are offered by US startups versus European startups, that gap is closing. We're seeing much higher percentages of European startup equity being allocated for their employees, full stop. So one of the things that you're going to get when you get to, let's say you do that Series A round, you go and you raise 10 million euros and you go out there and you hire 10, 15, 20 people, you're going to start allocating options to those people. And one of the biggest issues that we come across is what happens to those employees that came in, they were allocated options and then they left. Did they exercise those options? What happened to the options they were allocated that they didn't exercise? Where have they gone? So as you can imagine, as you get a little bit bigger and a little bit bigger and a little bit bigger, and you go from 20 employees to 50 employees to 100 employees, this is an issue that snowballs and snowballs and snowballs. And again, this is one of those things that you cannot track on an Excel spreadsheet. You need to put a solution in place, because this issue is just going to get worse and worse and worse. And when you have multiple employees cycling through your employee option plan, you're really going to get yourself stuck in this. The next one, not tracking convertibles. It sounds like such a simple thing, right? I mean, it's an easy thing to think about, post money safe and, what the calculations are on that. What we have come across, and we don't come across it as much as some of the other issues, but it's just something to really be aware of, is companies that do funding rounds by way of convertible instruments. So what I mean by that is they're stacking convertible instruments. So they might do a seed round and, they go out and they take 2 or 3 convertible instruments at that point that are all, 50 grand instruments. And then they go and they do another round 6 or 12 months later. And the round isn't big enough to trigger the conversion amount for the initial convertible instruments, but they're taking a bigger round of 50 grand chunks again, except this time they're taking in 10 of them or 12 of them or 15 of them. And what happens then is at some point down the road, and we've seen this, we've actually seen companies that have done up to, like 3 rounds, all on convertible instruments, and where there's been, north of 15 or 20 different convertible instruments stacked on top of each other. And what happens then is when it comes to, the investment that's going to come in, and it's going to be above the amount that's going to convert those convertible instruments. What happens then is, as they all convert and they stack on top of each other, the company gets diluted far more significantly than they really understood they were going to be. So like we've had this scenario where somebody has come to us and we've worked with them, got all their information together, and they didn't realize that the investment round that they were going to take on, apart from the dilution of that investment round coming in itself, that their convertible instruments combined were basically going to take, I think it was about 35% equity in the business. So there was this huge amount of equity that they hadn't realized was going just on those convertible instruments. And they figured actually if they were able to sort of keep going for another 6 or 8 months and get the company value a little bit higher, they'd be able to manage that convertible instrument dilution back down to a much more manageable level. So again, it's not something we would see as often, but if you're going to issue convertible instruments, number one, make sure you understand them. And number two, when you look at your future investment rounds, make sure you understand the difference between if we convert today at a 20 million valuation versus if we convert in 6 months' time at a 30 or 40 million valuation, how it impacts those convertible instruments. And probably the last one then is this fully diluted ownership. So, this when you start talking about things like who owns shares in your company, what's the share register of your company versus the other commitments that you have made. So again, this is looking at not just the people that equity has been issued to, not just the shareholders and the founders who own the shares outright, but those convertible instruments that are there, those warrants that you might have out there, those shares that you have reserved for employees and for options. So again, looking at that whole picture. So not just looking at the share register, but actually looking at the whole picture of your cap table, taking all those things into account and making sure that you really understand them. Because again, as I said, if you're going through this funding round and you do not have a good handle on this, you're going to make potential investors very, very nervous that you don't have a handle on the ownership of your own company. So I think this is really something that, there's not much else to say on this, but I just wanted to really cover off those couple of points. I think, covering off why global shares in particular, why we want to help in this space, right? Obviously, we're big advocates of employee ownership. So as you go through your scaling journey, you're going to need a really great team around you. And we're huge advocates of that and making that easier for people. As I mentioned, for global shares, we're 30% employee owned ourselves. Huge amount of those employees are based in Cork, and we're really proud of the fact that we're helping build that wealth in the region as well. Again, I think getting it right from the start and avoiding the future headaches. So this is really just about simplifying things, right? Just making it simple so that equity is not something you should have to worry too much about. It's not something you should be losing sleep over. But if you do not manage it simply, it is something that you will not only lose sleep over, but potentially lose funding over or lose a sale over. As your employee base grows, if you've got Irish-based employees and then maybe you add UK, European employees, you're going to encounter other types of employee options, and some of those have really, really powerful tax benefits. I had a story recently with a UK law firm who, they were working with a client who's really, really excited about the fact that they had just sold the company for 100 million pounds, and the employees within that company were stood to make 16 million pounds through their employee options from that sale. They were all really, really excited. They were less excited when they found out that the 16 million was actually only 10 million because they hadn't managed the process properly along the way. And as a result, they ended up paying significantly more tax than they should have had to pay. And this is, I suppose, a point that's worth making, which is there's a lot of things in the startup world and in the startup space that, we all sort of say, look, get it out there, get the product feedback, let's go to market, let's see what people say, what the customers need, and we'll fix it after. Your company equity is not something that's easily fixed afterwards, but it is something that's easy to manage if you do it right from the beginning. So I think, our message here is, we're big advocates of the whole startup ecosystem. There's a huge amount of good advisors in this space, but make sure you're talking to the right ones and people who understand equity management for startups, how to do it, how to keep it simple, and work that way. And look, that last point again, we're Irish and proud. We're from Cork. We're a Cork-based company. We're very keen to support not just the Irish startup ecosystem, but also the Cork startup ecosystem. And so very happy to give this talk with Republic of Work. There's a couple of resources. We can make these slides available afterwards, but there's a couple of resources that we have in here. So we have a short video course on equity management for Irish startups, and this just covers, there's a couple of law firms in there giving their little piece of advice around equity management. We have a couple of VCs in there talking about the types of things that they encounter and what you need to consider. And then there's a few other nuggets in there as well. We also have an ebook in there as well for your complete guide to Irish employee share plans, if it's something that is of use. And I think on that note, I think I am done, and hopefully ahead of time. And yeah, so I think that's it from me. I'm happy to take any questions. don't know, Sarah, do you want to pick up there?
Hello. That was great. Thanks, Derek. Really interesting. Does anyone have any questions, guys?
I guess I could throw a question there just to kickstart everyone.
Thanks, Rick.
Hi, Derek. I'm actually one of the Republic of Work employees. I'm the program manager at the Republic of Work, but I'm fascinated by what you do, so I jumped on the call as well. So just a random question, like how you probably already touched on it, like so like there's a very much a distributed some of the client startups I work with are pretty much distributed from the get-go. So one in mostly like one in America, one in Mexico, one in Europe somewhere, one in like India or so on. So and they're looking to the very early stage still, like they're looking to provide equity among the team as well, like they're a team of 5 or 6. What's your advice on I mean, it's probably a very long answer to it, but like what's your advice on how to kickstart the discussion, at least, you know, if anything?
Yeah, so it's a great question, Rick. So I think, look, however the world was pre-COVID, we know these things have accelerated massively since, right? Even the people that might have been working together in Ireland now find themselves distributed. So I think, look, there's a couple of things to think about. So firstly, in a lot of jurisdictions, there are what's called tax-approved share schemes, right? So, so if you take the UK, for example, the UK has one of the best startup share schemes in the world, right? It's a thing called the EMI scheme. And it basically means that anybody who is issued options under an EMI scheme, when they go to basically capitalize on that on the road, that they're going to be taxed at 10%, which is fantastic, which is great. But other countries have other benefits as well. So I think in the last week or two, I think Spain has just announced how they've increased the tax-free element of employee options. There's great changes in France as well. I think there's a lot of lobbying in Ireland too, to try and, you know, catch up with some of these other regions. But you're always trading off the level, you know, complexity or just, you know, even the headspace that you need to deal with this stuff versus just keeping things simple for employees. So what we would often see happen is that companies will do basically just a vanilla stock option plan, okay? And that in jurisdictions, in any jurisdiction with a couple of employees, those employees will just declare that any benefit from that, like, you know, effectively like income tax or potentially capital gains tax if they can in that region. But then what happens is, as a company gets a little bit bigger within a specific region, they then might say, do you know what, look, we've got this, you know, what's called an unapproved option scheme, right? So it hasn't been approved by any whether it's Revenue in Ireland or HMRC in the UK or wherever. So what'll happen then is they'll just go with an unapproved scheme, and then they'll hit a tipping point where they say, actually, do you know what? We've got 15 people in our UK team now, and there's a huge benefit that they could get from this EMI scheme. Let's go and have a look, and let's have a look at that scheme, and let's see, can we do all future awards out of this scheme, and potentially even shut down the old one and do that. So it's really just a trade-off between, you know, between the tipping point between scale and complexity.
Okay, brilliant. Thanks for that.
Any other questions?
I think,
hey,
yeah, Jack.
Eric, sorry, I was just going to jump in. Great talk. I'm just curious about safe notes and becoming much more prevalent now. In general, has that kind of alleviated a lot of the headaches that may have been associated with convertibles, or does it bring its own headaches, or they're sort of, is it as good as it seems to be, or what would be the pitfalls there?
Yeah, I think safes, if you look at where safes came from originally, I think Y Combinator created them originally, and even at that point, their goal was simplifying convertibles. And they used to do these pre-money safes, and now they're sort of doing the focuses on post-money safes, which again are simplified again. And then if you look at, I know NDRCs, for example, they've issued a very, I suppose, what's intended to be a very founder-friendly safe. And these are all good things that are coming just from the evolution, right, of startups, accelerator programs, easy investment, all those kind of things. So I think, personally, I think, I think safes are a very good thing, but it's just back to that piece of being conscious of stacking them, right, and just being aware of that. So if you're an early stage company and you're going to take on $100,000 investment, and you can do that by way of a safe, great. And if you understand the terms of that safe, for example, whether there's a valuation cap on that safe and what that means for you, and etc., or if it's an uncapped safe, and if you can understand those things, and it's worth making sure you understand those things, that's really, really good, and that can make your life really simple and really straightforward. But then you need to understand, if you end up taking 2 safes or 3 safes or whatever it may be, how do they stack up with each other, right? These are areas that you can make things more complicated for yourself. So I think if you keep it simple, a safe can be, a very, very useful and easy way to do things, keeps things nice and simple. You're not getting into a big argument today about valuation of the company. You're not giving away big chunks of equity for relatively small amounts of money. So I think as long as you kind of focus on those things, but again, you really need to understand how it works. And, there's nothing you can't figure out without, from spending half an hour on Google. There's a huge amount of information out there about safes. But as long as you understand the mechanics of it, I think they can be a very, very good thing.
Great, thanks.
Thanks, Derek. Does anyone else have any questions?
I'm off the hook, Sarah.
I think so too. Cool. Thanks so much, Derek. So I just popped a quick survey into the chat box there, guys, and I just popped my email in there again. If anyone has any Republic of Work related questions, just pop me a quick email and I'd be more than happy to help. Thanks again to Derek for today. It was a really great Lunch and Learn, and the recording of the Lunch and Learn will be available on our YouTube channel in the coming days as well, guys. So thanks again to Derek.